In 2021, Zillow lost over $800 million. They laid off 25% of their staff, and their stock crashed 87%, shedding over $43 billion in market cap. Yet, most of this was entirely self-inflicted. They poured billions of dollars into flipping houses, thinking they could become the ultimate flipper. They ended up spending money faster and faster and losing it all. This is how Zillow made one of the biggest and strangest misplays in business history. Surprisingly, those losses began with a very cautious, sensible approach. Zillow began dipping its toe into the house flipping business. House flipping is when you buy a house, make renovations, and sell it for a profit. Zillow was already the go-to real estate platform with all kinds of data at their fingertips. So this seemed like the next logical step. Why not get in on the action themselves? Zillow offers in April 2018. You could go to Zillow.com, enter your property details, and Zillow Zestimate would do an automatic evaluation. A pricing analyst checked it, made slight adjustments, and within 48 hours, you'd have a cash offer. It was fast, and Zillow handled most of the paperwork. It was incredible for homeowners because of how fast it was, since most people selling a home are also buying a new one. Zillow began buying homes in Phoenix, but by the end of the year, it was operating in 5 metro areas and had purchased 686 homes. The results were modest. Out of those 686 houses, they sold only 177. They made $52 million in revenue, but lost $27.2 million. Not great, but for a company the size of Zillow, it didn't hurt too much, and this was just the beginning. But then everything changed. Zillow began to scale Zillow offers fast. In 2019, co-founder and returning CEO Rich Barton set a bold new target: $20 billion in revenue in 3 to 5 years. How? By revolutionizing the real estate market through iBuying, or this new house flipping, aka Zillow offers. They stated a new goal of house purchases per quarter. Not 1,000 or 5,000, but 15,000 homes per quarter, or 60,000 houses every year. All of those to be renovated, then resold. This was a massive leap from under 700. That year, they expanded from 5 markets to 23. But things fell short. They purchased 6,512 homes in total, much lower than the target. Then in 2020, they purchased 4,162 homes, far below their goal. So Zillow made a few changes, not to their goals, but to the way they bought houses. They made some critical changes to make it easier to buy houses quicker, changes that would have a profound impact, and not just on Zillow. And to be fair, it did work. In 2021, Zillow acquired 3,805 houses in just quarter 2. Then, the next quarter, over 9,600 houses, more than the previous 5 quarters combined. They were getting close to their goal. Things were working, but their first test was unprofitable, and they were increasing from 600 purchases to 15,000. They scaled targets by 2,400%. Why so big, so fast? Well, in 2019, another company was making aggressive expansions, Opendoor, a pioneer in the iBuying model and much more ahead than Zillow. They raised $1.3 billion in funding and held 70% of the market share. This was essentially market validation for Zillow. But Opendoor wasn't alone. OfferPad, another similar company, had 26% market share, while Zillow had only 3%. They were far behind and felt pressure to catch up. Hence, that $20 billion revenue and 15,000 houses goal in such a short amount of time. It was driven by the need to outmaneuver Opendoor. In 2019, Zillow's market share jumped from 3 to 18%, but while that was growing, house sales were not. Of the 6,512 homes they bought in 2019, they only sold 4,313. In Q3 of 2021, they bought 9,680 houses, but sold only 3,032. Something was very wrong. Why were they selling fewer homes the more they bought? Remember that critical change they made? Well, that was removing the people. The experts who would double-check an offer. In the beginning, Zillow used their Zestimate system to value houses, but humans would review and adjust it. But not anymore. They put blind faith in their algorithm to scale as fast as possible. Full automation. They called it Project Ketchup. Zillow essentially removed the quality control of their offers, which came with a huge problem. Houses aren't commodities. Houses on the same street can vary in value due to things like views, lighting, layout, nearby shops, schools, and more. The algorithm couldn't consider all that. it gets worse. To scale faster, Zillow tweaked the algorithm to make more aggressive offers to win bidding wars, often offering 10 to 20% above market value for houses, especially in hot markets like Phoenix and Atlanta. That extra 10 to 20% was often over $100,000, and Zillow was buying thousands of houses per month. Zillow offers also created another unique issue. Zillow isn't just an iBuyer, it's a huge real estate marketplace where thousands of people list information and data on homes which are bought and sold. They used all that data for Zillow offers. But what happens when the company begins overpaying for thousands of homes? The algorithm believed the market was rising, so it offered even higher prices. It created a feedback loop, a compounding effect. The National Bureau of Economic Research said, the sizable effects in this algorithmic feedback loop raise a concern that the Zestimate algorithm has the potential to ingest market disturbance at any stage of the sales cycle and propagate it over time and across properties. Yet somehow it gets worse. Zillow's algorithm was bad, but what made it worse was the housing market. After interest rates were cut to zero in 2020, the market went into overdrive. More buyers, higher prices. Everything seemed perfect for Zillow. So they poured more money into buying homes. The plan was to buy high and sell higher, but that's not what happened. For the first half of 2021, the housing market was booming. According to housing studies at Harvard University, the change in price was up 12%. With inventories at record lows, existing home prices continue to head up. Zillow expected this growth to continue, but it didn't. Instead, the US housing market began to cool. Fewer buyers could afford these high prices, which slowed down sales. To make things worse, mortgage rates started rising, making homes even less affordable. Buying a house became even less appealing, and prices began to fall. But Zillow had already overpaid for so many houses. Now they began listing homes below what they paid. 66% of them with an average discount of 4.5%. This is where everything went wrong. In 2021, Zillow offers lost the company $881 million. Even after profits from Zillow's internet media business, at the end of 2021, Zillow had a net loss of $528 million. And they were stuck with thousands of homes, all with ongoing expenses. Zillow offers was a sinkhole of capital. House flipping requires lots of cash and usually has low margins. In a shareholder letter on November 2nd, 2021, Rich Barton announced that the company was closing the Zillow offers business and laying off about 25% of its workforce. He mentioned several reasons, but one was very clear. We have been unable to forecast future home prices at different times. This home price forecasting volatility has also contributed to significant capacity and demand planning challenges, exacerbated by a difficult labor and supply chain environment. The gamble had failed, and now Zillow was paying the price. Their competitors had also faced the same outcome. OfferPad saw a revenue boom through 2022, but by 2024, it dropped to under $1 billion. Opendoor's revenue also fell by 2/3. Most of the revenue was gone in just 2 years. House flipping wasn't dead, but the iBuying version of it at scale certainly was. Zillow went all in. Instead of chasing profit, they tried to be the biggest and fastest. Instead, they became the biggest loser. Zillow made the wrong move in the wrong place at the wrong time. And no one really felt bad because this was just another case of corporate greed entering the housing market, and this time it backfired big time.